I want to welcome everyone to today's webinar with Ryan Fisher and Matt Topley of Lansing Street Advisors. Just quick few slides here. CamaPlan does not give any investment, tax, or legal advice. We encourage you to work with your advisors, accountants, attorneys, or any other professionals that you think are appropriate. What is a self-directed IRA? Basically, a self-directed IRA lets you invest in anything that you want. The IRS never tells you what you can invest in, only what you cannot invest in, and that's collectibles and life insurance. So as long as it doesn't classify as that, then most likely you're able to use your retirement account to make an investment. These are the most frequent investments we see our clients using. Obviously, real estate's a big field. Matt's going to talk about that, so I won't, get into that. But that's residential, commercial, raw land, etc. Precious metals, that's physical, bullion stored. Notes and mortgages, another big field. Secured, unsecured, discounted notes, etc. There, and then private placements, which Matt can touch on as well. And that's private funds. A lot of those funds are real estate funds, note funds, private businesses, etc. You can use all types of retirement accounts. On the left, you'll see your tax deferred accounts, such as a traditional IRA, and on the tax-free side, the Roth IRA. If you're a business, so if you have your own business and you qualify for a health savings account, I think that's a great account to have if you qualify for it. You actually get to put money in tax deferred when you take it out for qualified medical expenses at some point. It's tax free, so take a look at that if you're eligible. This is my contact information. I can be reached at 866-559-4430, and my email is rfisher@camaplan.com. Fisher with a C, RFISCHER at CamaPlan.com. So I'll let Matt, I want to welcome you, Matt. Thanks for taking your time to give us this information today. I'll let you tell us a little bit about yourself and your company. And in the meantime, we'll switch over to your screen. So welcome, Matt.
All right, thanks, Rye. I'll share the screen here real quick. Rye opens it up here, but a little background on the firm. Lansing Street is RAA fiduciary advisor. We refer to ourselves as an education company. We're here to educate, support, and encourage prudent financial decisions. Briefly on my career, I spent 17 years on an extremely busy trading desk. Sorry about this. There we go. And then I spent 5 years as chief investment officer and partner at a family wealth office for clients 50 million and plus. So I was on the front end of Wall Street for a long time, and then 5 years plus making investment decisions for 50 million plus type families. And to sum up, what is a family office? We do it in an equation. We say family office is investment consulting plus advanced planning plus relationship management. Investment consulting, that's probably the most familiar with everyone on this call. That's 100% of our competitors. It's really built, in our case, it's built around your goals and built around protecting our clients from three things: transactional business, where the broker wins, you lose; sexy investments, Bitcoin, weed stocks, things like that. And then most importantly, we try to protect our clients from themselves, because we do believe that investing is a psychology game, not an IQ game. It's emotional decisions can really hurt you. Also on the investment side, there's a big difference between making money and keeping your money. So depending on where you are in your life, your investment horizon, the prospects, the way you invest, there's a massive difference between making money and keeping your money. So that's the investment consulting side. Then the advanced planning side, a couple different components. Wealth enhancement, we're always trying to mitigate your taxes and increase your cash flow. The more net worth people have, the more they lose track of their cash flow. Also under advanced planning, wealth protection, so insurance, fires, floods, cybersecurities, long-term care, trying to make sure you get the highest coverage at the lowest possible cost. Wealth transfer, all your trust and estate, your will, 70% of estates lose assets and family harmony. Also under advanced planning, exit planning for business owners. There's a lot of things business owners can do well ahead of time if they're facing an exit. And then charitable giving. We advise making sure you get maximum return on your investment, highest contribution in the most tax efficient manner possible. So that's investment consulting and advanced planning. And then the relationship management part, really, Lansing really offers a customized client experience. If you think of Mark Cuban and he has a staff of people in his office taking care of his personal financial life, we become the outsourced Mark Cuban for your family. We become the outsourced CFO, CIO of your family's financial life, right? So that little equation, family office equals investment consulting plus advanced planning plus relationship management, I think differentiates us from a lot of our competitors. And this equation prevents the plan from failing due to premature death, forced early retirement, lack of insurance, poor estate planning, poor long-term care planning. We're really helping families make life-changing decisions, not just their investment portfolio, even though that's very important. So protect your wealth, increase your cash flow, secure your legacy, and protect anything from sneaking up on you and your family. But today, we're going to discuss how this is a time in history that is different than any other, in the fact that we are facing some modern realities that no other generation in modern history has faced. Most people spend more time planning their vacation than planning their retirement. And at this time in history, we're going to face some things, talk about some things today that we're facing where we need to spend a lot more time thinking about our retirement, no matter how much money you have. It's going to be a changed game going forward. And I'm going to talk about those things today. Two
Matt,
people I would, yep.
I just want to interrupt real quick there. I did see a few questions come through, but I want to remind everyone else that there is a chat box and a question and answers, and we will get to those questions. So feel free to put that in at any time. And then people were also wondering, you still are on your first slide. We're just about to change it. So all good there. Go ahead, Matt.
Yes, so that was just the intro. Now we'll jump into the slides. Two research people I would like to thank. A lot of the talk is based on one book that I would recommend for everyone, Your Complete Guide to Successful and Secure Retirement, Larry Swedrow and Kevin Grogan. And then we're going to talk a little bit about real estate, and I would recommend Big Shifts Ahead by John Burns and Chris Porter. And some of the research you're going to see, I want to thank both those authors for making that research available. So why is now different than most of modern history? And the reason is we're facing 5 modern realities that previous generations have not faced. And I'm going to go through each in a bucket, but just to highlight them. Historical high stock valuations, equity valuations, historically low bond yields. I think we're all aware of that. Historically high private equity valuations. Now, there's a lot of different types of private equity, but private equity funds, especially, increased longevity, meaning we have a hockey stick of people living to 100. So your retirement planning is going to be 30 years in retirement as opposed to 5 to 10 years for previous generations. And then healthcare inflation. So let's look at each bucket in pictures. So stock market valuations. This is measuring the forward price to earnings yield in the S&P. You don't have to get into the weeds and understand everything here, but the price to earnings ratio is what most people hear on CNBC or websites on valuing the stock market. We have only been at a higher valuation one time in history, and that was 1999-2000. So we're not here to predict stock market crashes or anything like that. Nothing could be further from what we're trying to talk about. But where you start on the valuation side in the stock market gives you a very good indicator of what your future returns are going to be. And in stocks, our future returns are going to be a lot lower than they were the past decade, just based on math. We just had 2010 to 2020, a 13.5% return in the S&P. That's because from 2000 to 2010, the previous decade, the S&P had a flat to negative return. We went through the internet bubble and the 2008 crisis, and we came out of that and had huge returns for the last 10 years. Just based on math, the next 10 years returns will not be as good as the last 10 years returns. And then we could jump to, the bond market. I showed the chart here of when the 10-year Treasury, where we base interest rates on, hit its all-time low March 9th, 2020 of 0.5%, 52 basis points. So we're not going to get the kind of returns in the bond market that previous generations have seen. So bonds are simple math. To project the next 10 years return, you just base it off the coupon. So for example, on the top of this chart, the 10-year Treasury was yielding 3.8% on January 1st, 2010. The annualized return for that decade was 3.75%. Well, right now today, I believe, yes, the 10-year Treasury is returning 1.6%. It's rallied quite a bit from this generational low, we hope, in interest rates. So it's going to be hard to eke out returns in the bond market based on math. Private equity, we have a lot of money chasing private equity. There's firms out there that do a great job. I have a lot of friends in private equity. There's individual deals that people have expertise in, but as an overall asset class, it's trading at very high valuations, and so much cash poured into it after the 2008 crisis that there's too much capital chasing too few deals, and that forces them to pay higher and higher prices. Again, there's some good managers and some not so good managers, but the projected returns, because we're basing it off buying in higher valuations in private equity, are not as attractive as they had been for past investment periods. And then most importantly, this is the hockey stick of people living to 100. So we're about to face a time in history where we're seeing a massive increase in longevity. Most of the people on this call listening to this podcast are projected to live at minimum into their 90s, if not 100 plus. So we need to plan retirement for 30-year periods, and we're facing returns that are going to be lower. On top of that, we have also very applicable to retirement is we have healthcare inflation rising at 20%. So in this slide, you see the CPI for healthcare insurance is almost 20% right now. We would not expect that. We expect that to come down. We would not expect it to come down and match CPI, match inflation rate outside of healthcare. So we would expect healthcare costs to continue to rise. So to summarize, this is Vanguard's projected returns based on math. This is a capital asset pricing model. It is not a bunch of people sitting around a room making predictions, which I would highly recommend everyone listening to this podcast not to choose that as your investment thesis, listening to projections. This is strictly based on math and valuation. So what over the course of the last 200 years, when we started equity valuations, what do they return going forward the next 10 years? And when we look at bond valuations, what the returns look like for the next 10 years. So if you see that purple arrow on my slide, it's pointing to bond returns. And the first one there is the US aggregate bonds, which most people use that as their index, similar to using the S&P 500 index for stocks. And we see that bonds are projected to return based on math 0.7 to 1.7%. So that is not even keeping up with inflation. And if anything, what we've seen recently in the market, inflation will be higher than expected rather than lower. We don't know that for sure, but it's certainly looking like we're going to have an increase in inflation. And you go right down the list here, bonds are really projected to return under 2% for the next 10 years. On the other side of the screen, you have equities from various market caps and international, and what are they projected to return in the next 10 years. And you see US equities 3.5 to 5.5%. International equities projected to return a little higher. We don't know if this is going to happen, but based on math and valuations, we can project that that next decade is not going to be as good as the last decade. Your future returns are very dependent on where you start. That's why we point out these valuations. On the bond side, the entire bond index structure is negative for 2021. So bonds have had a negative return so far in 2021. Nobody in the current generations that are investing has experienced negative bond returns, and we may be experiencing that going forward. It's certainly a risk. A 60-40 portfolio, which is the basic portfolio that people try to use as their comparison indice. If we take an aggressive return from these projected bond returns and say stocks are going to return 6%, and then we match it with the projected bond returns, we're looking at a 60-40 portfolio only returning 4.6% for the next 10 years. And when we match that with longevity and an investment planning model that firms like Lansing are building, we need a horizon of possibly 30 years for portfolios to kick off income for families to live off. So we have this dramatically increased risk of long-term care. And, after 85 years old, 1/3 of people are going to experience Alzheimer's. So the average out-of-pocket cost for that is $200,000 to $400,000. So we need to plan based on lower returns, and we need to plan based off living to 100. And we need to find reasonable ways to increase returns, because small increases in returns compound at a much greater amount. The good thing about living to 100, Warren Buffett made 90% of his worth, 90% of his wealth after the age of 65. So if we plan properly and can let that money compound until you're 100, people will be surprised when we do our planning meetings how much money they'll have when they do unfortunately pass. So lifetime tax strategies, when to claim Social Securities, understanding Medicare, options for creating passive tax efficient income that we're going to talk about next, plan for potential long-term care expenses, insurance, and estate planning. All these things are interlinked, and we think now is a different time in history. We need one advisor guiding families through the interaction of all those different buckets. So again, the big positive news is living to 100, if you plan correctly, your money's going to compound a lot longer. And that adds another whole bucket of making sure you educate your heirs if you are going to leave a legacy and pass on wealth. But what are we going to do about this purple arrow here and the traditional fixed income portfolios? Families used to retire and put 50%, 60% of their money in bonds, because obviously at retirement, you don't want to take a lot of risk. We don't think that is going to be an available option for most families going forward. So one of the things we plug in at Lansing as a surrogate for bonds, and certainly we just want to say that real estate has risk. It's a private investment. We don't in any way want to say it's as safe as bonds, but it's one of the things we're doing for families that can afford to have some illiquid holdings in their portfolios. So why private real estate and why now? First thing is performance. Historical performance for private real estate is good, and is good relative to the S&P 500, let alone to fixed income portfolios. So looking at data from Preqin, a private real estate research group, we see that private real estate has a better return than the S&P for the last 17, 18 years or so. And most importantly, more importantly than the return, when you're building a diversified portfolio, you want to own asset classes that have a negative correlation to each other. That means when one asset class does well, the other one may do not so well, but we want to make sure we're protecting our principal, our initial investment. And if you look at the private real estate index, It has only a 0.23 correlation to the Russell 3000, which is basically a measure of the entire stock market. It has a negative correlation to Barclays US Aggregate, which is the bond market. And then it has a low correlation to the public markets REITs. So public market REITs have a very high correlation to the stock market. 80% of the move in any stock in the stock market is the sector and the overall market. So that leaves REITs buying real estate through the public markets at a disadvantage when it comes to non-correlation with the S&P. So real estate, good long-term returns, private real estate, low correlation to other things you're probably investing in your portfolios like stocks and bonds. And then other ways, other alternatives, have not done as well. We have a little chart here from Bloomberg on hedge funds, which some people use as an alternative to bonds. But we see hedge funds, there's many good hedge funds out there. Most of the hedge funds that are really good, listeners to this podcast don't have access to because they're closed. There's been an explosion in the amount of hedge funds. But if you look at this grid through up and down markets, the S&P has done superior to hedge funds for the last 10 years plus. 2020, S&P was down 5%, hedge funds were down 5.7. 2019, the S&P was up 31.5, hedge funds were up 13.7. So we think there's better options. And we use the index, we use the example, I should say, of the recent COVID crisis. So during the COVID crisis, comparing REITs to some of the private investments that we make at Lansing Street, the REIT index was down 30%, if you see that red arrow, after the S&P had started to rally out of the bottom of the COVID crisis. So the bottom of this chart, the date there, 3/24/20, kind of when we were at the all-time lows in the S&P in this sell-off. This chart showing you the S&P rallied back, and in May it was down 15%, but the REIT index was still down over 30%. And the reason for that is, obviously the exposure to office and retail in most public REITs really hurt them. In our case, the Lansing Street real estate deals that we were invested in and that we previously syndicated at my prior firm with the same sub-advisor, we were collecting 91% of our rents in March, 87% of our rents in April, and 89% of our rents in May. And the reason for that is we had little to no exposure to office and retail. We're primarily multifamily apartments and senior living. So we're going to talk a little about the demographics of those two buckets in the following set of slides. So multifamily apartments and senior living. Why is it so important to set up an investment portfolio for passive income? It's important always, but it's especially important in regards to those previous slides we showed in the unique time we are at in history. So earned income, what you work for all day, is taxed, at 30 to 50%, depending on your tax bracket. Passive income is the least tax, especially through real estate. You personally work for or spend your time and takes up most of your day to earn your income that is highly taxed, whereas passive income is you work the least for it, right? You hopefully invest passively in real estate deals. They kick off cash flow or mailbox money, and you are not working hard every day for that passive income. So there's very little leverage, bullet number 3, in your earned income. The only way you can increase that income is to work harder, increase your business, move up in the corporate world. Whereas passive income through a vehicle like real estate, it is leveraged. You get higher long-term returns due to that leverage. And we could talk about that if anyone reaches out in more detail. And then there's often no residual value for your work, right? You work hard, you get paid, you go back to work. Whereas in passive income, there's constant residual value as you roll over into new deals. So in the ultimate world, you'd be investing in deals. When deals refinance or sell, you reinvest those in more deals. And our offering absolutely gives you the opportunity to do that. And just something I found on CNBC, Tiger 21 clubs, like a YPO group or CEO group on steroids. There's very high bar to get into it. There was a picture of their portfolios in a story about Tiger 21 Club. And if you look at the purple there, 25 to 30% of their portfolio is kind of consistently in real estate. And when you get to that high net worth levels that Tiger 21 Club's at, it is protection of principal first, reasonable rate of return second, and growth third. And it's interesting that they keep 25% plus in real estate, but our thoughts at Lansing Street Advisors are that we think everybody at this point, hearkening back to the first two slides and what we're facing in the next 10 years and the low projected returns for stocks and bonds based on math, especially low returns for bonds based on math, that a good way to diversify your portfolio is through real estate, as long as you're using the best available sub-advisors and the best vehicle. So there's 4 fundamentals of investing, from Warren Buffett to anyone else who's built a lifetime of investment success. So return, obviously, and in our case, we're using sub-advisors with 20-year plus, 25-year plus track records. Risk, so cash flow with protection of principal is what we like on the risk side. And we think private real estate gives you an inflation hedge, meaning if inflation does indeed increase, which a lot of procrastinators are now predicting, we think real estate's a great hedge. Longevity hedge, meaning living to 100. It's a great longevity hedge to start investing in real estate now, keep on rolling over your deals, and when you do retire, have that passive income. And it's also a bond bear hedge. If we do face the first bond bear market that America has seen in 40 years, if we're facing that right now, we have 3 generations of people that are going to lose money in their bond market, in their bond portfolios for the first time in their lives. And then cost, our cost structure is very competitive versus other real estate offerings. And then for anyone who's investing in a taxable account, it's very tax efficient income. 95% of our distributions are long-term capital gains versus income tax. So anybody in taxable portfolios, we check the box on the 4 fundamentals: return, risk, costs, and tax efficiency. Obviously, if you're investing in a self-directed IRA, it's especially tax efficient. So let's talk about compounding a little bit and adding small percentages and the huge difference it makes in a long-term portfolio. So let's say we only returned 6% in our real estate deals or in our real estate offerings, even though we've been returning the deals that have closed in the high teens. So let's drop that all the way down to 6%, because we do not think that bonds are going to return much more than 3% in the next 10 years based on math. So an investor with $1 million earning 7% per year would have about 3.8 million in assets after 20 years before inflation and taxes. So you invest $1 million, you earn 7%, and you would have 3.8 million in 20 years. That same investor, if they added 300 basis points, 3%, and earned 10%, after 20 years, all else being equal, the investor would have 6.7 million. So 3.8 million versus 6.7 million by earning 3% more on your portfolio. So if you harkening back to the 60-40 that I mentioned earlier and the low projected returns for that for the next 10 years, if we can find a way to increase those returns from 4.6% to 7-8%, it's a massive difference in your family's long-term wealth by finding small things where we can move money without taking on much more risk, generating much longer term better returns, especially with the power of compounding if you're 10, 15, 20, 30 years from retirement. And if you can afford to live off other distributions and let this money compound forever for a legacy, it's quite a massive difference. Getting back to Warren Buffett made 95% of his worth after the age of 65. So there is illiquidity risk, obviously, in real estate. I want to point that out. You can't just press a button and get your money back, but for that, you should receive a premium, a higher rate of return. So it's important to keep in mind that there is illiquidity in real estate. So The other reason we like real estate as a bond surrogate and as a sleeve in everyone's portfolio, because of what we're facing, low equity returns, low bond yields, high private equity valuations, increasingly living to 100, and high healthcare inflation. We're facing a demographic in real estate where we think returns will continue to do well relative to stocks and bonds going forward. And why is that? We basically have 3 generations right now that make up 72% of the population: baby boomers, millennials, and Gen Z. A large percentage of those 3 populations are all going to be renters and continue to be renters. And let's point out a couple slides on why. So the biggest myth is that millennials are the only ones driving the rental boom over the past 10 years. Reality of the situation is, if you look at the top of this slide, the renter age groups 55 to 70 have seen huge increases in renters versus buyers of homes in the last 15, 20 years. So there's a lot of reasons for this. There's divorce at later ages, need for cash to retire, so selling their homes and renting. Some of them leaving the suburbs for urban life, and then a lot of them also following to wherever the kids and grandkids are, and they're renting in those areas rather than buying. But it's more vivid on this chart. Renter households age 60 and over drove the past decade surge in renters with 43% increase. So there's been a 43% increase in 60 and over baby boomers renting. Now think about that logically with what I said earlier, that we are projected to live to 100 years old. So these 60 plus renters will be in multifamily apartments or senior livings for the next 30 or 40 years, and baby boomers are the biggest part of the population. So this cohort of renter households age 60 and over is expected to grow by 18.6 million people by 2035. We also have a huge amount of boomers that are going to be selling their homes in the next 20 years. So seniors are expected to vacate 21 million homes in the next 2 decades. This is right out of the Wall Street Journal. That leaves 21 million households that will be selling if 40% of them, 30% of them become renters or residents of senior living. The demographics are hugely positive for those 2 areas. So also, as far as urban apartments, the myth was it was all millennials, and there was a lot of millennials, of course, moving to urban areas. But over the last decade, the total population of 20 to 29-year-olds grew by 4.7 million, but the total population of 55 to 64-year-olds was double that, 10.3 million. So more empty nesters moved into these urban areas than millennials, which most people would definitely guess the opposite. So on top of that, so we have baby boomers, and then we have millennials. Everyone has heard this story at length. The amount of student debt that millennials have is holding them back from buying houses. We've gone from, 250 billion or so of student debt, and this chart's a little dated. I apologize. I think we're close to 2 trillion, or we're definitely above 1.5 trillion in student debt. But what it does is it delays marriage age, and it delays home buying age. So historical growth of national student loan debt, you see it here clearly on this chart, and this just from 2000. So this is not a bad thing. This is just, there's a lot more people going to college. Most of the student debt is very manageable, but one thing it definitely does is it delays the home buying age for the millennial generation, leading to longer periods of renting. So that's the millennials. And then we have a few other things to check here that are positive for rentals versus home ownership that most people don't realize. We've had a massive increase in the United States in single parenting, which leads to less home ownership. We quadrupled the amount of women and increased 9-fold by the amount of men that are in single parent households, which leads to more renters than home buyers. We had a massive immigration population boom in the 2000s, the 1990 to 2010. We went from foreign-born population doubled in 20 years to 40 million. Also, this leads to more renters than buyers. Foreign-born population, roughly 50% of them become homeowners versus 67.3% for native-born U.S. citizens. So we have more and more baby boomers selling their homes and renting. We have millennials staying in rental apartments for a lot longer. We have single parent households, more renting than buying. And we have a huge immigration wave that happened in the 1990 to 2010 that is leading to more people renting for longer. And then this has all led to the highest median age of a home buyer in American history. Now, I know the housing market is doing well now, and I think it'll continue to do well. But we have a very low supply of homes for sale. And the median age of the home buyer hit its all-time high of 47 years old. It's starting to come down in the last year, but this chart's only about a year old, and the median home buyer age is 47 years old, which means people are renting in multifamily apartments and homes, rental homes, for a lot longer. And then getting back to living to 100 and the amount of boomers that are renting, this is the life expectancy, female total and male, that looking at it separately over now to 2060. And what it's telling us is that if indeed retirees are going to increasingly rent and then increasingly move into senior living, they're going to be living 20 or 30 years longer. So which is a very positive demographic boom for the areas of the market, especially that we invest in, which is senior living and multifamily apartments. So I'll stop it there, Rye. If you want to open it up for questions, does that sound good? I could talk about some more if you want, but I think we're 35 minutes in or so. So I'm more than happy to answer questions.
Yeah, Matt, thanks. That was some great information there. Someone did ask if you don't mind typing in a chat box the name of those books, and I'm sure if people email you, a few people asked if you'd be able to send them your slides as well.
Sure. I will type the names of those books for sure as soon as I find a chat box here. But I'll repeat them for everybody again.
You should, Matt, just at the top of your screen, put your mouse up there, and then it's going to give you options and show you that, and you should see a chat.
Okay, I see Q&A.
You can put it in that, but over to the right, you should see chat. If you put it in Q&A, they can see it from there too.
Okay.
And then someone else also asked, because the tax deadline was moved back to May 17th. Yes, I believe you do have, from what I've heard, you can make your contribution up until then as well. So that was extended.
Yes. That's correct.
Okay. And I don't see any other questions coming in other than that. But why don't you go ahead and repeat the names of those books too, so they can write it. So they can write it down too.
The Big Ships Ahead. That's John Burns and Chris Porter. It's demographics around real estate, and then there's Your Complete Guide to Successful and Secure Retirement. But you know, I would just say at Lansing Street, we're super focused on all these demographic areas and 5 modern realities right now. We're working with all our families on integrating investment planning, tax planning, trust and estate planning, insurance planning, in order to deal with the current positive thing in our mind, living to 100, especially around the 5 modern realities that we talked about in this slide deck. So boutique, trying to serve a small amount of families and have a huge impact. You can check us out at www.matttopley.com is my blog. If you want to sign up for the blog, it's matttopley.com. And then our company website's www.lansingstreet LANSINGADV.com, LansingADV.com, www.lansingadv.com.
And what's your email address, Matt? Some people want to email you to get your presentation.
Sure, it's mtopley, Topley, at LansingADV.com. M as in Mary, Topley at LansingADV.com.
What's after Lansing?
ADV, Apple David Victor, short for advisors, LansingADV.com.
Got it. I just put it in the question box there for you.
Okay.
Well, thanks for everyone who joined us today. And Matt, I really appreciate the information. Thanks for taking the time to give us this information, and look forward to the next presentation you have.
Sure. Thanks very much to CamaPlan. Thanks for having me on. Anybody who has any questions can reach me at that email or find us through the website.
All righty. Great. Thank you.
Everyone have a great day. Thanks. Bye-bye.
You too. Yep. Bye-bye.